Do you know whether your product margins actually reflect all of the costs that you've incurred? I'm Carl from KKG Accountancy. We look after the numbers for e-commerce founders. So you're importing goods from China. You pay the factory for the goods, you pay the freight forwarder for the shipping and the customs clearance, and you pay HMRC for duty and import VAT. That's three different parties with different invoices landing at different times across a span of a few weeks. My question to you is, do you know whether your accountant is currently tracking all of these invoices back to the shipment they relate to? And the follow-on question from this is, do you know whether your product margins actually reflect all of the costs that you've incurred? One of two things could be happening. You receive your freight bill and your invoice recognition software is set up to automatically code it to your overheads, thus inflating your profit margin. The second thing that could be happening is that your invoice is split evenly across all of the SKUs in your container. Here's a problem. Your freight forwarder is billing you on a greater volume or weight, which means that you're most likely selling your bulky items at a loss and overpricing everything else. Picture this, 20-foot mixed container, 1,000 duvets on one side costing you £10 per unit, on the other side, 1,000 blunt pots costing you £2 per unit. The freight forwarder sends you a bill for £4,000. The average landed cost for the freight is across the whole container £2 per unit. Here's a problem. In reality, by virtue of their volume, the duvets takes up to 90% of the total cost, giving you a landed cost much closer to a total of £14 nearly for the duvets and £4 for the blunt pots. Let's say you sell your duvets for £80 per unit. That's a drop from 32% profit margin down to 25% margin, purely based on the allocation. If you recognize any of these issues in your current business, here's a workable approach you can apply for the future. First of all, you want to make sure that you stop expensing any of your inbound supply chain costs into your profit and loss. Your freight, your insurance, your duty fees, clearance fees, they all cost as part of bringing your inventory to its current location and condition. And as such, they belong into the balance sheet as part of your inventory costs. On the other hand, your outbound carriage, storage, fulfillment fees, they all belong into the profit and loss. And it's important that you can make the distinction between the two types of costs and you can correctly track them into your accounting software. A question that we often get is, how is it that the import duty is part of your inventory costing, but not the import VAT? And the answer is simple, it's recoverability. You can recover the import VAT from HMRC, and as such, it's not part of your cost base. A second point to consider is, how do you define the apportionment strategy for each cost type? It's crucial you can document the way that you allocate your expenses across all of your SKUs. Your freight needs to be allocated strictly on the basis of how the carrier charges you, either be it chargeable weight or volume. Your insurance should be based on the value of the items being shipped, and your duty will be allocated based on the commodity code line. And lastly, you want to configure the technology around the rules, not the other way around. There are excellent inventory management softwares like Sin7 Core or Unleashed, with a landed cost module that's excellent at distributing your insurance, freight, and duty costs across all of your SKUs, so long as your apportionment is set up correctly. And this is where we sit down with the client to actually define those rules against the carrier invoices and the CDS entries to make sure that your costing system is set up efficiently. If you suspect you've been doing this wrong, here are two practical fixes you can start implementing as soon as possible. First of all, you want to make sure that you adopt the new method of apportionment as soon as possible. Ideally, a stock take or a year end, but not mid-period, just because you need that clear breakpoint. Secondly, you want to focus on that inventory figure showing your balance sheet. This is the figure most likely to carry all the historical errors to date. You want to look at the breakpoint that we identified just earlier and average out all the unit costs across all of your inventory and slowly flush it out into your profit and loss. One caveat though, the accounting standard stipulates that any material adjustment to your profit and loss will force you to restate your prior year balances. So make sure you have a discussion with your accountant to see whether or not this is required into your situation. If you import mixed containers, here's a simple step you can take today. Pull out your most recent carrier invoice and CDS entry. Check out your accounting system for the portion basis that's been applied to your freight, insurance, duty. If the answer is evenly or overheads, your per-SKU margin is skewed and you need to correct it before your next pricing and reporting decision. Here's a link below to more videos and also a link to our website. Thank you.